What's up, everybody? This is my presentation about day trading. What is day trading? How do day traders profit? As day traders, our job is to find stocks that are going to make moves. And stocks don't move essentially without catalysts. As day traders, we profit off of volatility. We can't make any money off of flat trading stocks. We find stocks that are going to make moves. It's our job to find the stock that's making a move, and if it's making a move, why is it making a move? We have to find the catalyst fast. And as day traders, we also need volume. There can be a stock gapping up, but there's no volume. If there's 1,000 volume, stay away. Volume provides liquidity. When there is a lot of volume, there is a lot of buyers and sellers, so it's easy for us to get in and out of trades. I believe the most market in the volume comes between 8 a.m., 9:30, 10 o'clock. Before we get into any of that, let's talk about risk tolerance. What is your risk tolerance? How much are you willing to risk into that single trade? Most traders fail because they don't follow a disciplined strategy. You need to be able to make quick decisions on whether to enter or whether to exit a trade. You need to be able to multitask and watch level 2. You need to watch the level 2. You need to see who's buying the ask. You need to see where the bid is. There's 2,000 shares of bid at 2.20. Okay, we can see that that is a type of support. We need to be able to watch the patterns and see how they form in real time. Now, does the trade that we are entering fit the strategy that we are using? Are you outside of your risk tolerance? Stay focused and stay calm. These stocks can make big moves. You need to know whether it is safe to get in. And it is a very quick decision. You need to be able to maintain your composure when you're a day trader following these very volatile positions. Another thing we can talk about is holding on to losing trades. When you hold on to a losing trade, you can come up paralyzed. It is important to stop losses fast. Make those quick decisions and follow your strategy. Managing risk is the most important tool to make good decisions. If you cannot manage risk, you cannot be a trader. Our job as day traders is to search for the volatility in stocks. Now, as beginner traders, you're not going to be able to recognize these patterns and get right in. When this video is done, you're not going to be able to get in and out of a trade and do your thing. Don't just throw yourself into any trade without any acknowledgement and understanding. Knowledge comes with experience or training. You need to be able to spot flags and patterns as they happen in real time. You need to be able to watch these things happen while they happen. Let's go into some trading terms. What is the previous open and previous close? When you pull up a stock, and I'll go into this more when we pull up another stock. It is simple. And a previous open is the stock's price when it opens, and the previous close is the close into after hours. What is the market cap? The market cap is the number of shares available in the market. What is the free float? This free float, this is something that comes up all the time. A free float is the number of shares available to the retail trader. What is a catalyst? And how does it affect a stock? A catalyst is a form of news, a release of financials, a merger, a meeting of shareholders, or a press release, FDA approval of a drug, a pill, a test kit. Now let's talk about how the catalyst affects a share price. The way stock share price is affected is a release of good financial report will bring in new investors. A good financial report will bring in day traders as well as long investors, possibly if they understand the fundamentals, whether temporary or long. Another type of form of a catalyst is an FDA approval. An FDA approval catalyst in a day trader will drive the stock's share price up. When we see FDA approval, that is a very interesting catalyst, and we need to get in on that as the news goes up. Good news makes the stock go up, bad news makes the stock go down. Now let's talk about level 2 data. Not a lot of people know about level 2 data. And as I read level 2 data, I can see the bids being support and the asks being resistance. And also, when you're trading stocks, if you see a certain, like a small number of asks, like 200 asks, and then you could see like 10,000 on the ask, that could indicate a short seller, or that could indicate somebody that's getting out of a trade. And we go through this more if you are in my mentor, but and we're going into this. How I determined a massive wall of either short sellers or sellers would bring the stock down, and we're going to go into level 2 after this. As I was watching NAKD, I determined that a wall of support was at point 1850 and the massive wall at point 16 would be either sellers or short sellers. Now we're going into this. You can see point 15.8. This is level 2. This is level 2 data that we're looking at. You can see at point 1580 there is almost 960,000 shares of support at point 1580. Now when you say, what is a wall? I post all the time, I'd say, oh, wall at 17, wall at 16. When I say wall, look at point 16. There is a 1.38 million wall share of resistance in NAKD at point 16. Now, we go into this. You can see right here at point 16, I was watching this real time. It got filled halfway here. It came down and got filled here more. I knew that 1.38 million share wall, if you see a wall like this, the stock's gonna go down. So you can see right here, the point 16 was partially filled here. I was watching this real time, and it was filled here. And look what happened. That big of a wall, or sellers, whether it's short sellers or sellers in general, brought the stock down. How it all comes together. Finding a good catalyst with a low float and no real level 2 resistance. You don't want to see that 1 point anything million wall in level 2. When you're finding a stock, you don't want to see that big of a wall in level 2. The lower the float, the greater the percentage gain. You look at a stock and it has 140 million float with a good enough catalyst that can move. But the lower the float, the greater the percentage gain, is what I've come to realize. Now, a low float and a good catalyst. So we choose our entry. It is a good catalyst and a low float, good volume, and we enter using one of our techniques. The lower floats, the lower number of shares available, the more likely the stock is going to make the biggest move. The floaters make the biggest moves. And we never buy at tops. We see a top, we see a stock moving. We either wait for a dip, we wait for a flag, or move on to the next. Just because it has a low float and good news doesn't mean we have to take a position. And also, beware that the low float stocks drop just as fast as they increase in value. We may use moving averages, trends, flags as entries, but if it isn't a good setup, we move on. And if you jump at a stock just because it is going up, you're setting yourself up for a bad trade. Me, I like to use a stop loss under 6%. If your set stop loss is 25% and the stock goes in the wrong way, you lose 25% of one position, and then to me, going into the next trade, you're going to go in wanting to regain that 25%. You keep your losses small so that when you go into another position, it's whatever. It wasn't a big loss, not a big deal. Now here's a low float example. Look at the free float here. 1.18 million. That's the number that you want to see. Now this is after the fact. I screenshotted this a couple hours ago. So this volume right here, you see 226,000, and you see an average volume of 3.61 million. Going into a new trade, you're like, I don't know if I'm gonna enter this one. It's only got 226 shares of volume, and the average volume is 3 million. But like I said again, this is after the fact. If I was looking at these numbers, I'd be a little iffy. Be like, okay, 226,000 shares of volume, 3.18 million. I wouldn't really throw myself into this big of a position here. But like I said, this is after the fact. This actually moved off a catalyst, and this free float, 1 million shares available. When to go long? When do I choose to go long into positions? You guys see me enter positions, and you guys see me take profits off the top, or you guys see me enter positions and don't take profits off the top, and then I end up getting stopped out at entries. When I go long, I like to take profits off the dips. And I also look at trends. This was Cat B that we traded. And like I said, sometimes I use moving averages in certain times. And I go over this more in general in my mentorship. But in Cat B, when we traded it, I said to have it on watch. I said to have it on watch around here. And what I did was, I took a dip trade off of the 20 moving average right here, which was 2.50. I signaled this dip on this moving average. And then we rode it up, took profits at the top. More bounces off the trend. Ears that I signaled. When stocks, this, you can see the moving averages here don't really communicate as good as the other one. But like I said, I go over that more in my mentorship. We look at different things at different times. But the best thing to look for is this bounce off the trend. It bounces off the trend here, bounces off the trend here, bounces off the trend here. And what I do in this, say if I took a position here, it would gap up here. I would take a little bit of profits off the table here and then hold the bounce. And if it got past my entry here, we would just get stopped out at entry. You have to be fast as a trader and you have to trade a certain strategy. You have to find the strategy that works for you. You have to find out what to look for when entering a day trade. Pre-market stocks that's at 4 a.m. gap up because of news released in non-market hours, but they also gap up because of news released in after hours. After hours can lead to pre-market and can lead from pre-market into market open. And market open stocks gap up either by continuation of pre-market, like I just said, or a new catalyst being released. And after hours gappers are reacting to news released after hours. What's the catalyst? How strong is the catalyst? You have to find the catalyst very fast. When entering a position that's gapping up, you see it gapping up, and it can gap up anywhere from 5 to 30 cents within a certain time. So you have to be able to find the catalyst very fast. That's when a stock is first gapping up. You see a stock is moving, you see it jump, you see it when you're looking at the scanner at 1.05, you see it jump from 1.10, 1.15, 1.20, and then you're interested, and you need to be able to find the news. Why is this stock going up? Don't allow yourself to get faked out by low volume. There's been plenty of times where you look at the scanners in after hours and you can see a stock that's gapped up 20 to 100% on 1,000 volume. You'll see these often. You need to stay away from those because you can buy in. You'll be able to buy into that position with 1,000 volume as a buyer, but with that 1,000 volume, you won't be able to liquidate the shares, and there is plenty of those that happen. I see those all the time. Sell or market orders. Market sells have slippage. As you can see on Webull sometimes, I go to enter a market sell, and all of a sudden it lags me out, and I have to re-enter in the information. That is a big fumble. Honestly, as a trader, you need to be able to have a broker that has hotkeys. Press one key in, press one key sell, press one key out. I use limit orders to get into positions, and I use limit sells to get out, because in a market sell you could experience slippage. In a market sell you could go to sell and the stock could move from 2.37 to 2.19. Find your strategy in entering trades and grow with it. A few of the strategies that I use when I enter in stocks is that I play flat top breakouts. Flat top breakouts happen when a stock is just reacting to the news and it's going up. I play those flat top breakouts. I play those. And bull flags, as well as breakouts of resistances. But different strategies can be used for different graphs. This strategy can work on one graph, but not work on another. There can be a bull flag happening, but then what happens? The bull flag breaks out into the bottom. I also trade dips of 10 and 20 moving averages. But like I said, these can only be integrated into certain setups, and I teach these setups. Also, don't stay into losing trades. Never. You can see here in Cat B, I have this setup here, and if you know what I look for and you know what I teach in my videos, you know what this is right here. What is this? This series of green candles, and then this series of consolidation. This is a bull flag, and it is a flat top breakout. As this stock gapped up, because of news. If you caught this here, which is always possible if you're that fast, you can catch this here and ride it out. Catching this here is what a flat top breakout is. This is a flat top right here, and then you're riding it up. But then this series of green candles and then this consolidation right here, you can see this green candle as like a flag pole, and then you can see the triangle right here. It equals out to a flag pole and then a flag, and then this right here, when it tips out into that triangle, is the flat top breakout. Like I said before, a bull flag is a series of green candles going up. It can be anywhere from 4, it could be 10, and then there was a series of consolidation. Kind of messed up there. Like I said, that bull flag, sorry about that, is that series of green candles. This is your favorite. This is what I love to play. That series of green candles and then this consolidation that leads up to a flag. And then usually what happens is right along the flag tip, it will break out to the bottom or break out to the top. A bull flag is a series of green candles going up. It could be 4, it could be 10, it could be 15, it doesn't matter. And then the series of candles in the sell. Analyzing these different terms like moving averages and bull flags and double tops, double bottoms, they are called technical analysis. The other form of stock analysis is called fundamental. Fundamental. When you do fundamental analysis, you are researching into a company. Understanding a company's fundamentals is always helpful, whether taking it into consideration for a day trade or an investment. For example, the electronic vehicle hype, the KNDI, the Tesla, the NIO, was a hot sector because it is important for the future. That is fundamental analysis. So we would look at gapping EV stocks, find out why are they gapping, if it is gapping because of a catalyst, and then we would take our position. Another type of fundamental analysis would be looking at SEC filings, looking at financials, and doing your own research into companies. As always, doing your own research into companies is always helpful. Never invest into bankrupt companies. Another fundamental analysis would be investing into a company that has a possible FDA approval. You see a company like ChemBio that is working on whether a pill, a vaccine. You do your own research into the company and find press releases that states that they are seeking FDA approval for a drug or a vaccine, a test kit that could make you want to invest into the company. Always do your research. Remember, this is your hard-earned money you're talking about.